We're analyzing Swiggy Limited, trading as Swiggy on NSE and BSE as of 24th of October 2025. Disclaimer: this video is for education and information only. It is not investment advice or a recommendation to buy, sell, or hold any security. I'm not a CB registered investment advisor or research analyst. The video may contain errors or omissions. Do your own research and consult a licensed professional. I have not received any compensation from the issuer or its affiliates for making this video. There are no affiliate links, and this is not a solicitation for advisory clients. Any risk management or portfolio frameworks discussed are generic, product-agnostic learning tools and not instructions to trade. Let's talk about the company name, ticker, and analysis date. We are analyzing Swiggy Limited, ticker Swiggy, listed on the National Stock Exchange of India and the Bombay Stock Exchange. The analysis date is 24 of October 2025 in the Asia-Kolkata time zone. Let's talk about what the company does. Swiggy operates an at-scale hyperlocal convenience platform in India with two high-frequency pillars: on-demand food delivery and quick commerce groceries. The marketplace connects more than 500,000 restaurant partners to consumers via a large last-mile network of roughly 250,000 delivery partners. Instamart provides rapid delivery of daily essentials, typically in 10-30 minutes, across more than 40 cities. Surrounding these cores, Swiggy offers Dine Out for restaurant reservations and discounts, Steppin' Out for curated events and experiences, Genie for peer-to-peer pickup and drop, and a co-branded credit card to deepen engagement. The paid subscription Swiggy One has scaled beyond 3 million members and is used to improve frequency and retention. Let's talk about products and services. Food delivery is the foundational marketplace launched in 2014. Swiggy earns through restaurant commissions, consumer delivery and platform fees, and advertising by restaurants and brands. Instamart, launched around 2020, is an inventory-led quick commerce model using dark stores to deliver groceries and essentials within 10 to 30 minutes. Revenue is largely driven by take rates, delivery fees, and advertising, while major costs include inventory, fulfillment, and store operations. Dining out and events through Dine Out and Steppin' Out adds off-app and on-ground engagement. Platform innovations include initiatives such as ultra-fast, bite-sized food formats with nearby QSRs, snack-first discovery experiences, private label cloud kitchens, and operational technology like AI-assisted dispatch and early drone pilots. Light logistics and Fintech are provided through Genie and a co-branded card designed to increase frequency and lifetime value. Let's talk about revenue mix. Food delivery remains the single largest revenue contributor, but its share has reduced as newer engines scaled. In FY 2024, food contributed roughly 46% of revenue, down from about 80% 2 years earlier. Quick commerce contributed close to 9% of FY 2024 revenue, but already represented roughly one-third of consumer gross order value, near 33%, and has been the fastest-growing leg. Swiggy's B2B supply chain and distribution business accounted for about 42% of FY 2024 revenue, up from roughly 1,465 crore in FY 2022 to about 4,780 crore in FY 2024. Dining, events, and platform innovations combined represented low single digits, around 2 to 3%. The direction of travel is a multi-vertical local commerce platform where food remains the economic anchor, while quick commerce and B2B drive incremental growth and act as additional monetization surfaces. Let's talk about stock performance since listing. Swiggy listed on 13th of November 2024 at an issue price of $3.90 and closed day one at $4.56, up about 17%. The stock reached a high near $617 on 23rd of December 2024. In spring 2025, the shares corrected on profitability concerns, touching a low around $2.97 on 13th of May 2025. That is a peak-to-trough drawdown of roughly 52%. From the May low, the stock recovered by about 40% into October 2025 and traded around 423-430 on the analysis date, which is approximately 10% below the first day close and about 30% below the peak. Over the first 11 months post-listing, the effective CAGR is close to flat to slightly negative due to that round trip. Let's talk about the revenue trend in the last 3 fiscal years, and on a trailing basis. Revenue from operations increased from about 5,705 crore in FY 2022 to roughly 8,265 crore in FY 2023, to around 11,247 crore in FY 2024, and to approximately 15,227 crore in FY 2025. That sequence implies a FY 2022-FY 2025 compound annual growth rate of roughly 36%. There was no annual revenue dip in this period. Growth drivers included higher order frequency and average order values in food delivery, rapid Instamart expansion, and a major step-up in B2B distribution. On a trailing basis into FY 2026, momentum remains strong, with a representative quarterly year-on-year growth print in the mid-50s%, roughly 54%, indicating continued high double-digit expansion from a larger base. Let's talk about new products and services and management's forward mix guidance. 3 vectors are emphasized. First, speed and proximity for small-ticket, high-intent use cases through ultra-fast formats that emphasize tight radii of roughly 2 kilometers around QSRs and micro-kitchens. Second, profitability in Instamart through network density, higher baskets, better sourcing, and improved store operations. A slump sale and subsidiarization of Instamart was approved in September 2025 to sharpen governance for inventory-led retail and provide capital-raising optionality. Third, deeper monetization on the main app via platform fees, restaurant and CPG ad tech, and subscriptions such as Swiggy One. As a directional frame, management has discussed food delivery growth in high teens percentages, with quick commerce growing faster from a smaller base, and B2B scaling steadily. Over the next 12 to 24 months, the mix is expected to shift by a few hundred basis points in favor of quick commerce and B2B, while food remains the economic anchor. Milestones described include Instamart contribution break-even targeted in roughly 18 to 24 months, around H1 FY 2027, and company-level adjusted EBITDA break-even on a multi-year path oriented toward H2 FY 2029. Let's talk about order book or backlog. A traditional contracted backlog is not applicable to this on-demand model. Revenue visibility is driven by user cohort behavior, the subscriber base of more than 3 million members, city and category expansion, and continued densification of the logistics network, rather than project-based order books. Let's talk about whether there was a dip in revenue and why. There was no annual revenue dip across FY 2022, FY 2023, FY 2024, and FY 2025. Some quarters can show slower sequential progress due to seasonality or a high base, but that pattern did not constitute a trend reversal at the annual level. Let's talk about EBITDA trend in the last 3 fiscal years. Adjusted EBITDA remained negative but improved sharply in FY 2024 before a modest step back in FY 2025. A representative path is an adjusted EBITDA loss near 3,910 crore in FY 2023, improving to about 1,836 crore in FY 2024, and then widening slightly to around 1,911 crore in FY 2025. FY 2024 improvement reflected higher take rates, the introduction of a per-order platform fee of about 2-3, stronger advertising monetization, and delivery cost efficiencies. The slight deterioration in FY 2025 reflected renewed growth investments. Let's talk about why EBITDA dipped when it did. The FY 2025 dip relative to FY 2024 resulted from higher marketing and discounting to acquire and retain users, inventory and dark store operating costs tied to Instamart expansion, elevated non-cash ESOP expense around the time of listing, and upfront spending on platform innovations. These choices were intended to extend category leadership and operational density after a year of margin improvement. Let's talk about EBITDA margin trend in the last 3 years. Consolidated EBITDA margin improved from approximately the negative high 40% in FY 2023, around minus 47%, to the negative mid-teens in FY 2024, around minus 16%, then softened modestly in FY 2025, around minus 12% to minus 13%, due to the reinvestment cycle. Management expects sequential improvement ahead, supported by density, monetization levers such as ads and platform fees, and efficiency gains in last-mile operations and store management. Let's talk about debt to equity and whether debt is high. As of 31st March 2024, total borrowings were roughly 2,112 crore against net worth around 9,057 crore, indicating a debt-to-equity ratio of about 0.23 times. With cash of about 5,354 crore as of June 2025 and minimal incremental borrowing, effective net leverage by FY 2025 end was close to zero, around 0.03 times. FY 2025 interest expense, near 71 crore, was not a material constraint. Based on these figures, debt is low and not a primary risk factor for the company. Let's talk about cash flow conversion and how it compares with peers. Operating cash flow improved from approximately minus 460 crore in FY 2023 to roughly minus 313 crore in FY 2024, then widened to around minus 2,169 crore in FY 2025, as inventory days increased to about 59 and receivables expanded with growth in B2B. In a peer frame, Zomato Eternal delivered positive operating cash flow of roughly 308 crore in FY 2024. InfoEdge generated strong, steady cash with FY 2024 profit after tax around 1,394 crore, while Paytm 197 and PB Fintech showed improvements but not consistent free cash flow positivity. On this basis, Swiggy's cash conversion today can be characterized as weak relative to this peer set, with a plan to tighten working capital cycles and lift contribution margins over the next 4 to 8 quarters. Let's talk about the stock price trend in the last 1 year and the drivers. Across the last 12 months, the stock moved from the first day close of 456 on 13 Nov 2024 to a peak near 617 on 23rd Dec 2024, then fell to about 297 on the 13th of May 2025, and recovered by about 40% to the 423-430 zone by 24th Oct 2025. The principal drawdown aligned with a wider than expected quarterly net loss, approximately 1,081 crore versus about 540 crore a year earlier, together with risk-off sentiment toward loss-making tech. The recovery corresponded with reiterated margin roadmaps, the decision to hive off Instamart into a subsidiary, and a liquidity-enhancing agreement to sell an approximate 12% stake in a portfolio company for about 2,400 crore. Let's talk about promoter share activity. Swiggy does not have an identified promoter group under CB. Promoter holding is 0% and promoter pledging is 0%. Founders and early investors are classified under public shareholding. Let's talk about valuation lenses and how Swiggy compares. On the price-to-earnings lens, trailing earnings are negative, so PE is not meaningful at present. On price-to-book, Swiggy has traded around 9.5 times book, above several Indian internet peers. Zomato has been near the 3.5 to 4.0 times range, InfoEdge around 2.5 times, Paytm near 2.8 times, and PB Fintech around 2.1 times. Swiggy is not meaningful because EBIT is negative. Zomato's EV/EBIT has screened very high, around the 80-100 times range, because EBIT is only modestly positive. Under traditional lenses, PE, PB, EV/EBIT, Swiggy screens fully valued to overvalued relative to peers that already print profits. Many market participants therefore discuss EV sales and unit economics progress as alternative ways to frame potential. For context, EV sales for Swiggy has been cited in the mid-single digits, around 6 to 7 times FY 2025 sales. Let's talk about variables and risks. Cyclicality and seasonality are low because food and essentials are everyday categories. There are predictable spikes around weekends and festivals. Input cost risk is medium because fuel, delivery incentives, and discounting intensity can compress contribution margins by 100 to 200 basis points during adverse periods. Customer concentration is medium. Retail demand is diversified, but the B2B line includes a handful of large accounts. Together, 2 customers contributed roughly 2,357 crore in FY 2024. Capex and working capital intensity is medium to leaning high in quick commerce. Inventory days around 59 in FY 2025 indicate higher working capital usage than an asset-light marketplace. Policy and regulation are medium, including antitrust, e-commerce policy clarifications, and potential gig worker benefits that could raise costs. Foreign exchange exposure is low. Revenues and most costs are INR denominated. Execution risk is high given simultaneous scaling across multiple verticals, roughly 600 dark stores, and a last-mile partner base in the 2.5 lakh range. Technology disruption risk is medium, as open networks and alternate discovery frameworks could pressure take rates and visibility if the platform fails to adapt. Contingent liabilities are low based on available disclosures. Let's talk about whether the business is cyclical or seasonal. This is not a materially cyclical business. There is mild seasonality, higher order volumes on weekends, festivals such as Diwali and New Year's, and event peaks around major sporting seasons like the IPL. The combination of prepared food and grocery helps smooth some of these effects. Let's talk about the latest developments in the last 1 to 2 months. In September 2025, the board approved hiving off Instamart into a subsidiary via a slump sale to sharpen governance and enable clearer capital options for inventory-led retail. Around the same time, the company agreed to sell an approximate 12% stake in a portfolio company for 2,400 crore, which, together with cash of about 5,354 crore as of June 2025, extends liquidity runway given the FY 2025 operating cash outflow of about 2,169 crore. Festive merchandising on Instamart expanded into curated health-oriented categories such as no added sugar and high protein. The next scheduled communication around Q2 FY 2026 at end October 2025 is being watched for evidence of margin progress. Let's talk about analyst sentiment in the recent period. During September and October 2025, several brokerages expressed buy or accumulate views with 12-month targets broadly in the 500 to 565 zone, which implies around 20 to 30% upside from the 423-430 area. A minority of houses remained cautious with targets closer to 380 to 400, emphasizing valuation versus negative EBITDA. The tone improved as the stock rose roughly 40% from May 2025 lows, while management reiterated milestones for Instamart contribution break-even and company-level adjusted EBITDA break-even. Let's talk about mutual fund and FII ownership trends. Domestic mutual funds increased their stake from roughly 5.51% in March 2025 to about 9.85% in June 2025, a quarter-on-quarter rise of around 434 basis points, and to approximately 11.9% by September 2025. Domestic institutional ownership, including other domestic institutions, reached around 15.95% by September 2025. Foreign institutional investors initially reduced exposure after listing, then became net buyers, FII ownership increased from about 4.90% in March 2025 to roughly 12.23% by September 2025, an expansion of about 733 basis points across 2 quarters. Let's talk about promoter contribution and pledges. Promoter contribution is 0% and promoter pledging is 0%. Large shareholders within public shareholding include Prosus at approximately 25.4%, SoftBank near 7.6%, Excel around 5.4%, and founder CEO Sri Harsha Majety around 4.9%. Let's talk about regulation. Swiggy is not a tariff-regulated utility. It operates under India's e-commerce and competition frameworks, food safety rules, the GST regime, and evolving labor standards for gig workers. The most material policy watch items include potential outcomes in antitrust, any policy choices that affect platform fees and commissions, and a possible expansion of worker benefits that could increase cost by triple-digit basis points if broadly implemented. Let's talk about growth outlook from management's recent communications. Management reiterated a durable runway, high teens growth in food delivery, faster growth in quick commerce from a smaller base, and steady B2B scaling. The operating theme is profitable growth, food funding itself, with a focus on narrowing Instamart losses through store density, mix upgrades, and better sourcing, while deepening monetization via ads, platform fees, and subscriptions. A sequential improvement in adjusted EBITDA is an explicit objective. Let's talk about an educational framework for investors who hold at a loss. This is not advice. One generic, product-agnostic learning approach is to review whether the original thesis remains intact based on a few observable checkpoints. For example, whether segment-level profitability in food is sustained, whether Instamart's contribution margin improves quarter on quarter, whether consolidated adjusted EBITDA margin trends better, and whether balance sheet liquidity remains adequate relative to operating cash needs. If those checkpoints move in the right direction, some investors, purely in theory, study holding or reducing exposure to volatility through position sizing and time diversification. If those checkpoints fail across multiple quarters, some investors, again in theory, study reducing exposure to manage risk. Let's talk about an educational framework for investors who hold at a profit. This is not advice. A generic framework used in many markets is to protect gains by defining risk in percentage terms rather than price points, to consider partial de-risking when volatility rises, and to let the remainder participate in potential upside if fundamentals keep improving. The parameters and thresholds in such frameworks are individualized and should be determined with a licensed advisor after assessing risk tolerance and financial goals. Let's talk about an educational framework for a fresh entry. This is not advice. A widely taught risk management concept is to avoid concentrating decisions at a single moment and instead spread decisions over time, sometimes called staging or dollar cost averaging. Another concept is to seek confirmation in the fundamentals, such as evidence of sequential margin improvement, before increasing exposure. The definitions, metrics, and thresholds vary by investor, and individual suitability requires a licensed professional's guidance. Let's talk about the closing take. Swiggy's model spans more than 500,000 restaurants, about 250,000 delivery partners, over 40 cities for Instamart, and more than 3 million subscription members. Revenues rose from about 5,705 crore in FY 2022 to roughly 15,227 crore in FY 2025, a compound growth rate near 36%, without an annual revenue dip over those 3 years. Adjusted EBITDA losses narrowed in FY 2024 and then widened modestly in FY 2025 as the company reinvested in growth, particularly in Instamart. Debt appears low with a debt-to-equity ratio around 0.23 times as of March 2024, and effective net leverage close to zero by FY 2025 end due to cash on hand and portfolio monetization plans. From a valuation standpoint, PE and EV/EBITDA are not meaningful, while EBITDA is negative, price to book around 9.5 times and EV sales in the mid-single digits frame, the discussion alongside unit economics progress and the timeline to profitability. The path management has articulated includes Instamart contribution break-even around H1 FY 2027 and company-level adjusted EBITDA break-even toward H2 FY 2029. For educational purposes, the variables to monitor include quarterly margin progression, working capital intensity in quick commerce, ad and platform monetization, competitive dynamics, and the policy backdrop. Please use this as a factual, structured summary to support your own research and consult a licensed advisor for any investment decision.